Bird, the e-scooter company, just had its 5th birthday, but they're not celebrating.
Happy birthday!
Oh,
Because the era of the millennial subsidized lifestyle is over and Bird's wings have been clipped.
All right, before we hit this, can you share your number one fear about scooting, Jack?
The e-scooters that you stand on, well, first of all, the wheels are so small. If there's a rut in the road, I'm going head over handlebars.
I feel very vulnerable.
I feel very vulnerable.
Then what are you afraid of falling into, by the way?
Street juice. A puddle of street juice in New York City. The nastiest substance on the planet.
Street juice. It's kind of nasty. It also helps you lose 5 pounds, but it's scary. Yetis, 5 years ago, Bird, the e-scooter company, launched.
Finally, a scooter for adults. You can scoot to the office and not be embarrassed that you're on a razor.
And then 4 years ago, Bird surged.
It was the fastest ever startup to hit a $1 billion unicorn valuation.
And then 2 years ago, Bird hit a $3 billion valuation. It was worth half a lift.
And then 1 year ago, it went public. It couldn't use the ticker symbol Bird because Allbirds had just gone public and snagged that ticker symbol from under them.
And today, what is Bird, the e-scooter company stock doing, Jack?
The stock is down 95% from when they spacked onto markets.
Get this, Bird stock is now a penny stock. It is trading at 54 cents a share.
Valuation was $3 billion at the peak. Today, it's $150 million.
Now, we know what you're thinking. Street juice concerns aside, what is the main problem that has destroyed the e-scooter industry more than like any other consumer tech?
The answer? It no longer has VC to get a bailout from.
For years, electric scooters attracted us with extremely cheap scooter rides to go from point A to point B.
They opened up in like 2018 with $1 per ride and 15 cents per mile. You could get there for $3 when an Uber would have cost you 15.
And that ride was so cheap, Bird actually lost money every time you rode a scooter.
But venture capital was fine with it because Bird was growing. So they wrote a check and bailed Bird out.
Venture capital was always there to bail him out.
But now Bird is a publicly traded company. They can't turn to venture capital to plug their losses anymore.
Because Bird doesn't have that support system there anymore, they've had to change their prices.
Yeah, big time. Those $3 rides, that's in the history. Today, the equivalent ride is double that, like $6.
You'd be taking a scooter to go on a date. It used to cost you a chicken nugget. Now it costs you a chicken dinner.
And those price increases, it's not an inflation thing. It's because venture capital isn't paying for half of your ride anymore.
So, Jack, what's the takeaway for our buddies scooting along over at Bird?
The era of the millennial subsidized lifestyle is over.
Yetis, Jack and I were telling you a month ago, it was time to say goodbye to the free DoorDash delivery codes and those lovely Lyft discounts.
Man, it was a great decade. For a decade.
I had a blast.
For a decade, if you lived in the city, you could download an app and get incredible convenience for incredibly low prices.
Put in discount code podcast to get $5 off your third order every 4th day of the month.
But that era is over. And Bird is a painful example of that.
The unit economics on every Bird ride show that Bird's growth wasn't driven by a fantastic business model.
You tried out Bird because venture capital made the price artificially cheap.
Yes.
Now that a 20-minute scooter ride is like $6, that's barely less than a taxi. It's less compelling.
And now that Bird is publicly traded, public investors, they don't want to pay for our millennial subsidized lifestyle.
We've told you how the end of that millennial subsidy hurts us consumers.
Well, now we're seeing how it hurts the companies like Bird, too.
Thanks for T-boying with us. Don't forget to like and subscribe to this channel for Pop Biz every day.